Thank you for joining me this Friday, the 12th of July. I'm Grady Wolf, market analyst with Bell Direct, and this is the weekly market update. Well, there is one clear way to describe the US market this week, and that is record run. The S&P 500 notched 7 straight record highs, topping 5,600 points for the first time and posting the 37th record close year to date, while the Nasdaq also closed at record highs throughout the week. Stocks specifically, Apple shares topped $232.98 for the first time ever this week, and the iPhone giant stole the most valuable listed company status from Nvidia. The driver of Apple's rise to the top this week was rising investor optimism of the tech giant's introduction of AI into the iPhone product line, which was announced late in June. Now, there is really no denying that markets and consumers alike are all about the AI revolution in 2024. So, can valuations really stay this high? And what is driving Wall Street to record territory? The short answer is yes, valuations can continue to grow as long as earnings continue to grow, unless of course the stock is deemed overvalued, which may lead to a pullback. To determine if a stock is fairly valued, undervalued or overvalued, there are a lot of formulas and technical practices involved. However, a simple way to gauge the value of a company is to compare the company's price to earnings ratio, aka the PE ratio, against the average PE of the sector it is listed in. If, for example, we take Apple shares, which are at $232 per share and currently trading on a PE of around 35 times. Given Apple is part of the tech sector, which is known for a high growth status, the average PE in the sector is around 32 times. So Apple trading slightly above could suggest it is overvalued. However, the expansion into AI and growing earnings has the valuation and some analysts saying it is fairly valued at this current level. All markets are economic data and rate outlook driven right now, and the US rally of the week just gone cements this point further, following Fed Chair Jerome Powell's latest comments and recent economic data, including non-farm payrolls and unemployment rate, coming in favourably compared to economists' expectations. Just overnight, we saw the release of US inflation data, which paves a solid pathway for the Fed to consider cutting rates as early as September. The core inflation rate month on month for June fell 0.1% from May, while the US inflation rate year on year for June fell to 3% from 3.3% in May. Both key readings came in cooler than economists were expecting and indicate the Fed's aggressive interest rate stance to date is working to cool inflation to the target of 2%. Investors are bolstering their equity positions and adapting portfolio constructions to optimize returns ahead of anticipated rate cuts. So we are seeing investors move into sectors that perform well in the lower interest rate environment. Fed Chair Jerome Powell boosted investor confidence this week on the rate outlook front, or rate cut outlook front, after he outlined that keeping interest rates elevated for too long risks economic downside through weakened economic activity and employment. Inflation drivers remain stickier in Australia than in the US, so the rate outlook here remains more uncertain, with the RBA not ruling out raising rates or holding for longer due to wages price inflation, housing inflation, retail sales and services inflation all remaining stubbornly elevated. So, with all of this in mind, where are the opportunities for you to consider in the current market environment, and what should you look for in the months ahead? Well, financial stocks continue to outperform the market in 2024, with the sector up 15.33% year to date, as investors see the banks will benefit from the higher for longer rates thematic. The tech sector is still running hot and has legs to continue its recent rally for some time, as companies expand into AI and enhance potential earnings. And earnings season in August will be the key catalyst for you to keep an eye out for, as this will determine exactly how listed companies are faring in the high interest rate environment and whether the recent equity rally and growing valuations are fair or overpriced. When assessing each company's reports, be sure to look for outlook into FY25, earnings growth or lack thereof over past financial years, levels of debt and profits. Each sector has key metrics we also look for to determine performance. For example, in retail, be sure to check the company's inventory levels, as this will indicate whether the company must run sales or write off stock as a loss, or whether they are successful in managing their stock levels. Locally, from Monday to Thursday, the ASX 200 rose 0.86%, which was weighted to the tail end of the week after an early sell-off to start the week. Communication services and tech stocks led the market gains this week, with the sectors posting increases of 2.57% and 2.4% respectively. At the other end of the market, materials and utilities stocks came under pressure over this week. The winning stocks were led by Red 5 jumping 12% on a trading update and restructured hedge facility and security package. Perseus Mining rose 10.92% this week, and Emerald Resources added 7.9% over the 4 trading days. And at the losing end, Strike Energy fell 6.52%, SiteMinder lost 5.85%, and Alumina posted a 5.34% loss this week. On the broader market or the All Ords, they rose 0.78% over the 4 trading days as Anson Resources soared 23.08%, Aura Banda Mining rose 16.42%, and Catapult Group International jumped 12.29%. Red Hill Minerals tumbled 25.38% over the 4 trading days, while Meteoric Resources lost 25%. The most traded stocks by Bell Direct clients this week were Magellan Financial, Drone Shield, and Telstra Group. Clients also bought into BHP and Zip while taking profits from the big 4 banks being NAB, CBA, Westpac and ANZ, and of course they took profits from CSL as well. And the most traded ETFs by our clients this week were led by Hyperion Global Growth Companies Fund, Magellan Infrastructure Fund and Vanguard Australian Shares Index ETF. Looking to the week ahead from an economic calendar standpoint, we may see markets react to China's GDP growth rate data for Q2 out on Monday, alongside industrial production and retail sales data, as these 3 key readings will paint a clear picture on how the world's second largest economy fared in the second quarter and if it continues to struggle with the recovery post-pandemic. US retail sales data is out on Tuesday, with the market anticipating a flat reading on May as cost of living pressures continue to bite. And the European Central Bank, or the ECB, will hand down its latest rate decision later next week, where it is widely expected Europe's central bank will maintain the current level and cash rate of 4.25%. And that's all we have time for this Friday. Have a wonderful weekend and happy investing.